Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining us this afternoon, we have Chuck Fuller, Portfolio Manager at Nasdaq Dorsey Wright, Sara Mehle, Senior Index Research Strategist at Nasdaq Investment Intelligence, and Bryan Novak, CEO and Portfolio Manager at Astor Investment Management. We're here to discuss if stocks are showing signs of being overbought and if the rally may start to take a breather. It is great to see all of you again. Bryan, let's kick it off. Let's get your fundamental thoughts here for a moment. Really not much has changed in terms of the macro picture relative to the conversation that we had back in May.
Yeah, not much has changed recently. I think a couple of things to note are we're really going to be watching the labor markets because there was an indicator that was out today. The new home sales was not a very good number. Those numbers continue to move down. So it's really focused on the consumer. The job numbers have been steady. There's a bit of a discrepancy between the household survey and non-farm payrolls, but I think we really got to keep an eye on that because that's going to drive the thought behind what's going to drive the market in the near future.
Yeah, and Chuck, if we take a look at how the S&P 500 and the Nasdaq 100, they're up, pretty high double digits year to date. I guess really the question is, do U.S. equities retain their leadership, and are you starting to see overbought conditions?
Yeah, I think we are starting to see, some overbought conditions, at least over the short term. We had the pullback in April. Really, we've gone straight up since. And now you've got the market up. I think it's about 15 or 16% for the year, which would be a great yearly total, right, for the full year. We're not even halfway through so far. So, I think it would make sense for the market to pull back a little bit here, over the short term. And that can happen in multiple ways. It could be that the price pulls back, or it could be a correction in time where we just kind of move sideways for a bit. But we're also seeing some things kind of underneath the surface that suggest that, maybe we have a pullback in price. And what I mean by that is, we're seeing a divergence kind of between cap-weighted indexes and the stocks underlying them. So we've got the market at all-time highs. But, if you look at the percentage of stocks in the S&P that are above their 50-day moving average, it's only about 45%, and usually that number would be north of 70%, if we're at all-time highs. So seeing a lot of stocks hitting 52-week lows and hitting 52-week highs at the same time is also kind of a sign that we could see a more substantial pullback than what we typically see.
Yeah. And Sara, from the Nasdaq 100 perspective, when you look at it in terms of the market weighted performance relative to equal weight, the numbers are quite glaring there.
Yes, over the last month, I thought it was pretty surprising to see the Nasdaq 100 up about 6.61%. While if you look at those same 100 stocks just equally weighted, it's up just 54 basis points, so 0.54, which I thought was pretty surprising and shows you really how much those names at the top are driving this index higher. I just want to echo Chuck's thoughts. I just checked in the Nasdaq 100 index based on its Dorsey technical overbought or oversold reading is 103% right now. Doesn't mean that it can't get higher, but it definitely is extended. We haven't seen a pullback from a technical perspective, and so I just wanted to echo Chuck's thoughts there.
Right. Well, Bryan, that really is the question that the market is asking itself. Are we going to start to see momentum shift elsewhere from the AI trade? Is it going to start broadening out? And it almost felt like in May, we were seeing that transition more into energy utilities, and kind of tells the demand story of what's happening with AI. But when you look at the market over the past couple of weeks, it just goes back to the mega cap tech trade. I mean, there's got to be other areas in the market that this can start to broaden out. Is the first issue. The second issue is, these companies are going to have to perform during earnings. Look at the multiples they've been awarded.
Yeah, I think that's right. If you look beyond those really heavy mega cap stocks, the infotech sector, the GICS sector, has actually performed very well. Like month to date, it's up 11%. But if you look elsewhere, the average return, not weighted, but average return of the GICS sectors is 1%. So you have on the high side 11% for the infotech sector. So there's still the big focus, not just on the mega caps, but on that AI trade, as you mentioned. You look elsewhere, you're starting to see aggregate demand soften below aggregate supply on consumer discretionary. So what's going to drive that? Like, you really need a driver. And as I mentioned, if the consumer is seen to be a little bit softer, is it going to come from discretionary? They've been the big driver the last couple of years, but how really strong can they be, especially if rates continue to stay elevated? We're not going higher. But those rates, the longer they stay up, the longer an effect they have on the market. And I think if the AI trade does start to peter out, I mean, I think you have to watch out. I think you have to be concerned about a necessary pullback in the market.
Right. And Brian, that really is what we're grappling with, right? Is a bifurcation in the economy and how it's impacting certain sectors of consumers. Even if we were to get 1 or 2 rate cuts this year, it's not going to move the needle in terms of how perceived affordability from 2019 to here. When you have, let's say, insurance costs as an example of 25% is, 25 or 50 basis points on a credit card balance really going to make that much of a difference. I think it's a tough spot for the areas within the consumer space for people to grapple with.
Yeah, no, absolutely. I think if you look at the average credit card rates, as you mentioned, it's north of 22%, I believe, which is the highest it's been in like 3 decades. So that's not affecting everyone, because on the high end of the economy, those consumers are still doing well, but the lower end, like, they're feeling a lot of pain. And if you start to see these elevated rates stay up there, I mean, if we get into the refinancing cycle, we've got extremely accommodative IG and high yield OAS spreads versus treasuries. Like, they're very accommodative. You start to see elevated, if you start to see those widen out or go north, I mean, I think that's going to be a bit of a concern, and that'll start to weigh in the psychology. And then that'll end up being the bifurcation. We'll see the bifurcation start to align, but unfortunately, probably align on the downside.
Yeah. Well, Chuck, let's talk about this. What other sectors besides technology are you seeing strengthen?
Yeah, I mean, so we've got industrials are up at number 2. Obviously, technology at number 1, but yeah, industrials at number 2, financials at number 3 in our rankings. So, that's kind of where we're seeing the strength. And on the downside, things like real estate, utilities, healthcare are still kind of low in our rankings. Even though utilities had, I think, a good month that we talked about last time, they pulled back some this month, so they're still kind of at the bottom.
Yeah. And Sarah, if we take a look at top contributors to the Nasdaq 100, they're not, I mean, there are some mix of sectors in there, but what other areas are performing well when you think about different factors in different areas?
Yes, as you mentioned, I think, the top contributor year to date is NVIDIA. I don't think anyone's surprised by that. Some other semi names up there: Broadcom, Qualcomm, Micron, Applied Materials. But also we have, Microsoft, Meta, Amazon, but Costco is still up there, which I think is always a surprise. It's one of the top weighted stocks in the Nasdaq 100, and really being dragged still by Tesla, Intel, Adobe, Pepsi, Lululemon, and Starbucks. So, a lot of those consumer discretionary names. We also saw, as I mentioned, a huge month for semis. So our SOX index up over 13%. Also a positive month for the Nasdaq Clean Edge Green Energy Index. So CELS is the symbol there. And also a huge month for tech dividends. So up about 7.14% for the Nasdaq Tech Dividend Index. So, we saw tech add 5% to the Nasdaq 100 over the last month. The second top contributor was discretionary. Healthcare added about 50 bips, but we're really seeing the index dragged here by basic materials, staples, and real estate.
Yeah. And Chuck, what about international equities? So certainly the argument to be made there is, the valuations are certainly more attractive.
Yeah, they definitely are. In our rankings, they actually fell from number 2 to number 3. Commodities actually took number 2. It's not by a huge margin. They're kind of neck and neck, but it was pretty notable to see that happen. Their performance, here over the last month was pretty bad. Almost every country was down. I think the ACWX was down about 2.6% overall. So yeah, we're not seeing a lot going on there. I think, now the year-to-date lag, the U.S. equities is something like 10%. And that just kind of goes with what we've seen over the last, 10 to 15 years, right? That's just international just has a very hard time competing with the U.S.
Yeah. And Sarah, what regions made the biggest move?
So over the last month, the Nasdaq Global Index was up about 62 basis points. And when we look at, international, when we take a look at emerging markets versus developed, really did see some dispersion there. The Nasdaq Emerging Markets Index down about 1.7%, developed up 0.84%. So really, as Chuck mentioned, just still seeing that relative weakness with U.S. versus international.
Yeah, Brian, you know what I feel like I'm still grappling with, where in May, everyone was talking about, okay, we understand the technology exists, but how are we from a private and public perspective going to be able to supply the energy that's required for these data warehouses and different applications and programs and software to run? And that's why we saw, you know, it was a very unusual move for utilities to have the run that they did. And then it just kind of seems that it's backtracked and there's such short-term memory.
Yeah, I think that's why a lot of people are starting to get on the sort of secular commodity bandwagon because, you know, for the longest time, commodities in a very low interest rate environment didn't do a whole lot. So I think, you know, we're in an environment where, yeah, rates may come off a bit over the next, 6 to 12 months. We'll probably get one this year, next 12 months, but we're still going to be elevated in that type of environment. I think as we move forward, the need for that energy, I mean, we had some fits and starts with the whole electric vehicle thing and how we're going to source and feed that energy. But this is a real thing. So I think that, you know, allocating and staying, you know, around in the energy, especially in the metals contributors. I know copper has gotten pulled back a little bit recently. That might offer a good buying opportunity for people that are looking for an attractive point to get back into copper after that run up, because those things are going to contribute well to not just this energy provision for AI, but also just for the housing market when it does rejuvenate, as well as the industrial pickup. I think those are some areas that you can actually look for some attractiveness outside of equity specifically.
Yeah, and finally, Brian, to wrap up here, I feel like the 10-year, you're still seeing the velocity and the move of rates. I think we're still trying to get used to how, you know, quickly they've been moving. I mean, from a historical perspective, the spreads are pretty wide.
Yeah, the spreads moved, and I think when we looked at, you know, a couple of weeks ago when CPI came out, we dropped pretty fast and hard on the front end. We dropped about 15 basis points. It did normalize, but I think as we move, the MOVE index, which measures volatility around the long end, it's actually come down in recent from where it was a couple of years ago. And I think because the short end's a lot more the one that's easier to handicap because we know what the Fed's doing with their policy. It's highly unlikely that they're going to have to hike rates into a higher inflation environment. But if inflation is a bit more sticky, maybe we don't get the same pull-offs, but that'll keep under control the short end. But it's the long end that becomes a conundrum because I don't think that we're going to see a huge spike in rates on the long end because there's a lot of natural buyers on the long end that want the interest rates that they're seeing at this point. So I think we should see something under control, which should generally be better for markets and for investors. If we can see, okay, CPI, PPI, those things have indicated to us that maybe inflation is going to be a bit more subdued than the last couple of months have indicated. So I would keep an eye on that because that'll get investors into better mood as we move into the third quarter.
All right, guys, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you.